Hello and welcome to Talking Global Infrastructure. I'm Vlad Benn, Senior Policy and Research Manager at the Global Infrastructure Investor Association. In this episode, we're going to be breaking down the results of our biannual Infrastructure Pulse Survey, put together with Alvarez and Marsal. Every 6 months, we're tracking how investors are feeling about raising and deploying capital, where they see the opportunity across different sectors and regions, and what the primary barriers to investment are. The Q2 2026 report marks our 6th year of running this survey, and there's been an incredible amount of volatility. In late February, we've had various military campaigns launched in the Middle East. The Strait of Hormuz, which carries roughly 20% of the world's seaborne oil and gas, has effectively been shut for 2 months. Oil is trading above $100 a barrel, roughly double where it was. We've seen central banks on both sides of the Atlantic lowering their projections for growth, freezing any kind of hopes of rate cuts. And against all of this backdrop, we have 3 really fantastic guests on the motley crew of the Pulse survey who are going to help unpack all of the findings here. And perhaps I'll allow each of you to introduce yourselves.
Hi, thank you, Vlad. Wayne Jephson. I've been here at A&M for just under 7 years, and I lead our infrastructure team in EMEA, focused on the financial diligence aspects of the work. Good to speak to you again, Vlad, and looking forward to it.
I'm Moody. I lead A&M's energy and infrastructure practice in the U.S. I've been with A&M for about 17 years, and I lead our transaction advisory group specific to energy and infrastructure in the U.S. and happy to talk about U.S. and broader North American trends today. Thanks, Vlad.
Hi, I'm Filippo Gaddo, Managing Director here at A&M in the Infrastructure Capital Projects team. Been here about a year, and I got 25 years experience in the kind of energy and infrastructure sectors, and I lead our economics practice. So I'll bring a little bit of that kind of macroeconomic trends kind of perspective to the conversation today, hopefully. Thank you, Vlad, for having us.
Thanks, Filippo. You couldn't have three better people to help us unpack our results for this quarter. And perhaps kind of sticking with you, Filippo, talking about the macro trends, the environment at the moment. We're recording this in May 2026, and the world looks very different to one over the last survey. So, Filippo, what's going on? How would you describe the environment?
Yeah, thank you, Vlad. I think you mentioned already some of the key events that happened over the last kind of few weeks and months. And I would say we are a little bit at halfway through a business cycle. If you think about the business cycle, normally tend to last between 5 and 10 years. This one started in the post-COVID. So you had a big inflation, and then inflation came down, but then the recovery started kind of picking up steam. So we should be in the middle of kind of accelerating, having good steam and going forward. But obviously, this cycle has been interrupted by probably a couple of events. One of them about a year ago, the tariffs, famous Liberation Day. We talked a little bit in our kind of latest podcast last year. And now kind of the impact had kind of gone through and people absorbed that and adjusted to it. And then suddenly we had the conflict in the Middle East between the US, Israel, and Iran. And that has another kind of bit of a shock. As you said, prices went up above 100. They came down a little bit. They keep on going kind of up and down depending on what happens on the ground. And the implication is that the macroeconomic environment, which was supposed to be slightly lower inflation, lower rates, lower cost of capital, and therefore kind of from an infrastructure investment point of view, a good and benign environment, suddenly turned around again. So nobody's talking about cutting rates. And in fact, you might even see rise in interest rates potentially. We had a very, very split decision at the Fed last month, and who knows what they're going to say in June when you have also a new chair, kind of Kevin Walsh, kind of replacing Jay Powell. That's a big change actually from a rates point of view. From a macroeconomic, therefore, you are a little bit of what should have been a relatively kind of benign environment. Suddenly, there is a lot of uncertainty. We will discuss later on today how has it affected investment and the sentiment, and maybe I'll pass it on to Wayne, talk a little bit about actually how is that kind of sentiment in Europe.
Yeah, I think if you think of how Europe's been impacted this time around, you go back to 2022, and that energy crisis highlighted how exposed Europe was to imported gas. And whilst Europe has taken action to try and improve its fuel security, it remains a net importer of fuel, and you can't change the energy mix overnight. 20% of global oil and LNG passes through the Strait of Hormuz, and with that being closed at the moment, there's a direct effect on the UK and Europe, and a shortage of supply, which leads to inflation. What does that mean? It means that the central banks are looking to the future and the inflation forecasts, and they see a creep upwards in inflation, and therefore are thinking of responding through interest rate rises. Indeed, the Bank of England have strongly guided towards a rate rise at their next meeting. Why does it matter for infrastructure? I mean, I guess aside from the obvious of a reduction in demand for GDP-linked assets, higher interest rates mean higher financing costs, which will make core asset transaction more difficult to finance. If you look at other sectors, power assets, for example, may see some benefit, particularly those with merchant exposure, as higher prices feed through and they reap rewards, whilst other sectors, for example, such as airports, particularly those with traffic movement driven tariffs, they will see their revenues and their EBITDAs decrease over the summer as airlines consolidate their takeoff and landing schedules in response to fuel shortages. So no shortage of impacts, both from a specific European perspective, but also to think about from a specific sector perspective.
And I think before we get on to the US, the Bank of England isn't the only one talking about rate rises. I think I saw Lagarde and the ECB point in the direction that should the environment get worse, should the supply shock, the energy shock have a detrimental effect on the European economy beyond what we're seeing now, they are very ready to hike interest rates to protect the economy. And I think last year they were the first to come to their baseline, and this year we could see them again be the first to raise rates. But the Pulse survey kind of covers beyond Europe as well and the US. So Jay, how is the US sitting in all of this?
Yeah, I mean, look, I think the US obviously has come under more attention given the recent Iran and Israel conflict. The US continues to splinter from a political standpoint. Continuing to be more extreme on the left or the right seems to be the way that you win elections. And so that's something we're definitely seeing in the US. And so it's hard to speak for the entire US because there definitely are many different views. And I think even on the international stage, we hear a lot, that different investors are very interested in what the US is doing, and mostly viewed probably with the concern that it is likely to cause increases in inflation and potentially interest rates, which obviously will impact infrastructure investors. If you think about the elections coming up, in general, during a midterm election, typically the party in power will lose some of their seats. It's just been a trend over many, many years. And so I think there is a baseline assumption for 2026, which those elections happen in early November, that the Republicans obviously will still hold the White House for another 2 years, and potentially the Senate, which is up for debate. And then there's an expectation right now that Democrats will gain a majority in the House of Representatives. The reality of what happens when you have a split House and Senate is typically less things get done. And, honestly, from an investor standpoint, sometimes that stability is probably the most important thing you can have.
And I think that's a great piece to frame all of this discussion in, where our survey takes place, and perhaps gives you an understanding of the environment investors are having to navigate at the moment, which is becoming even more complex. And something that we're seeing in the data, and we'll get onto as well, is this difference between sentiment towards the market, the country, the region, versus that we're seeing for the infrastructure sectors. And perhaps we can come to unpack a lot of the sentiment towards countries and regions that our investors have. Filippo, maybe if you can talk us through some of the headline scores. I just say before I give you the floor that this is the 14th wave of the Pulse survey. There's a good amount of historical data we have going back to Q1 2020. And I think this wave shows something that we haven't seen before European countries on the rise simultaneously. The US has fallen in sentiment a little bit. Is this the European moment, Filippo, or is Europe just a beneficiary of the US dysfunction?
Yeah, it's a very, very, very good question, Vlad. And as an European, I wish there is the European moment where we take the mantle from the US and we start leading the world. I think there is a little bit more of the latter. I have to say there is relativity. It's all relative to a certain extent because you can potentially kind of increase in the positive sentiment because of the deterioration somewhere else. So there is definitely some of it. In the United States, for reasons that kind of Jay can talk a little bit more later, there's been a little bit of deterioration. So the sentiment go up a little bit in the US because investors want to rebalance a little bit. So you see definitely that movement. The second element is you probably saw some genuine positive sentiment about a recovery in Europe, driven by the need to invest in infrastructure for security reason primarily. So that's why you could see that Germany is quite positive. A lot of investment, relaxed the fiscal kind of rules there, potentially a lot of investment in defense, which we all know now is becoming an infrastructure asset class as well. Therefore, you could see that kind of sentiment going up. So that's probably a genuine. Having said that, the survey obviously was covered the period pre and post some of the conflict that we see in the Middle East. So from a macroeconomic point of view, you probably see now that kind of trend, which was generally even on the numbers going up in Europe, potentially pausing a little bit. And you may see some countries potentially going down in the future from macroeconomic. I'm not talking about the sentiment yet. So we will need to see what the impact it might have. So probably I would say a bit of both. As always, I would probably say driven by the core. The interesting for me was actually France, because France was going through some kind of crisis from a political point of view last year and seen actually some positive results. It means that again, the market kind of adjusted to the situation and maybe thought about, well, this is not going to go down badly as maybe it was a few months back. They will kind of continue to kind of muddle along to a certain extent, and therefore we can actually kind of get on and invest in a time of turbulence. Having said that, there are elections next year, so we'll be interested to see that.
Yeah, I think that's a really interesting point about election and the turbulence, something that will come on to the barriers, but you see European barriers to investment, political instability, particularly trending downwards for the last 3 quarters, which is an interesting point because you see the US political instability trending the wrong way. And I think, again, when we did the survey, it was a similar kind of time last year as well, where we had pre-Liberation Day tariffs, the sentiment around the US positive, post-Liberation Day tariffs, anyone who filled out the survey, slightly more negative. And we've seen this same sort of juxtaposition now again. And on the US, Jay, there's been a bit of a deterioration in sentiment. And I think this is actually the biggest change of any major market in our survey history. So what's driving this? Tell us a bit about the US. What's going on?
Look, I think we have to keep in mind where we're coming from, right? If you look at the sentiment, it's still positive for the U.S. It's still very positive for the U.S. and pretty in line with a lot of Europe. But it did come down significantly, and I have no doubt that what we've already talked about is why, which is there is a lot more uncertainty around some policy topics. Things like offshore wind are an example there. And also the events that happened in Iran that were right around the same time of our survey. So I do think there was just a lower amount of interest in investing in the U.S. until there's more certainty around policy. I hope that happens. Obviously, as we have political candidates that go more and more left or right, unfortunately, they like to rip up bills that were written by the other side. And so that, to me, is honestly the longer term fear, is just that we can't have more longer term planning and infrastructure agenda setting inside the U.S. Overall, I would say U.S. sentiment is still pretty strong. As one investor said to me, you cannot not invest in the U.S., right? You might not agree with some of the policy decisions, but just given it's the largest economy, if you're going to be an infrastructure investor, I think there's still a lot of interest in the U.S.
Absolutely. I think the deepest market on the risk return spectrum, as others put it, the data shows this yo-yo effect between rising sentiment and lowering sentiment. And it actually tracks, I think you mentioned a few of them, Jay, tracks quite specific events. We had Trump election drove a slight dip in Q4 2024. Liberation Day drove another collapse in Q2 2025. Then, as Filippo said, the market priced in a lot of those dynamics, priced in the tariffs. The tariff impact wasn't as significant as people had anticipated, and we saw sentiment just completely rock back up, which was great to see. And each shock is almost followed by a recovery. But what you see in the data is that the recovery never goes back to its peak. The trend line is always is kind of downwards at the moment. And again, perhaps we'll unpack a little bit of why that is. But my favorite kind of question, and it has been for the last year, is this European recovery. I've been so invested in making sure that Europe, gets its time in the limelight after the US, because in H1 we saw that kind of policy disruption last year, and we talked about it a little bit. But we've seen, I suppose, fiscal announcements, fundraising tilting towards Europe, and the money just flowed back at the end of it in H2. Sentiment recovered, deal flow picked up. Now, Wayne, are we just watching, Top Gear on Dave +1 now? Are we seeing a repeat of the same thing this year?
Yeah, that's. I think that's a great analogy, to be honest. Look, I think it's fair to say that Europe has in part benefited from part of the dysfunction elsewhere, particularly in the US, and there's further political instability expected in the UK over the coming months following last night's local election results. I think there's also the fact, though, that some of the political instability, which actually Filippo touched on a few minutes ago in France, seem to have subsided somewhat. So again, that is also, some of the more turbulent economies seem to have come back to a more neutral position. But I think that said, also, Europe has helped itself, and Germany, as its largest economy, is probably the driving force behind that improvement in sentiment. If you look at Germany, there's loads of positive policy announcements and a sense of direction as an investor-friendly economy, particularly for infrastructure. You've got the 500 billion infrastructure special fund. There's the Germany fund. There's a commitment to climate neutrality by, I think it's 2045, and a commitment to lower bureaucracy, to speed up planning, approval processes, and allow a more favourable environment for investment. So Germany is definitely the driver, I think, of the improved sentiment, and it's given a bit of a halo effect to the remainder of Europe as its major economy outside of the UK.
I think they call it the bellwether. That's what Germany is for European recovery, right? And I think I agree with you, Wayne, as well. Something that's different from last year to this year is that last year, the European kind of case rested on a lot of narrative and announcements rather than any concrete policies taking place. And as you mentioned, the German special fund, that's now constitutional. We have Rearm Europe, that's in legislation as well. And none of those are reversible by the next election. And again, Filippo, you mentioned the defense theme too. That's a structural driver that didn't exist last year. And again, talking about that political instability point, again, the EU is seen as that stable market to invest capital in. The political instability score is the lowest it's ever been, and we've seen 3 waves of decline. So that's a year and a half of decline, essentially. So we've touched on this: the far right surge largely gone away, snap elections, coalition difficulties. Those things are a lot less threatening now than they perhaps were last year, which I think is the driving force. And fingers crossed for Europe that this continues. And before we touch on kind of further thoughts, Filippo, should we stress test this kind of European re-rating? What are the risks to Europe this time round?
Yeah, it's a good question. I mean, the danger of actually having some positive sentiment based on relativity, meaning relative to other areas, is if those areas suddenly they saw themselves out, then you lose out. So that's the danger of not having a kind of positive sentiment based on your own strength as opposed to the weakness of the other. So that's probably one risk. If suddenly the rest of the world gets all kind of very tranquil and stable and attracting investment, then they pull away necessarily to a certain extent from Europe. So that's probably one risk, maybe a minor, but definitely risk. The three big ones for me are: the one is about the instability, particularly when it comes to energy and prices, and the feed through to inflation. At the moment, there is some level of stability, if you want to call it that way, in the situation in the Middle East, but it could get worse. And in which case, then suddenly this kind of very early stage recovery in Europe might actually be kind of strangled in its infancy because of additional macroeconomics and geopolitical events. So that is one risk and is always there. But I think these days, as we've seen the last 5 years, is probably a higher risk than it would have been in the tranquil time on the 90s or just before the financial crisis. The second one is something that is we picked up a lot when we were at various events and conferences, for example, in Berlin as well, is about execution. You said, first of all, you got the mood, then you got the policy that's been passed, as you mentioned just now, in legislation, but then you need to execute it. You need to kind of develop the project and start actually putting metal, or if you want to call it that way, or copper, or whatever the infrastructure is, in the ground. And that's the problem. So we will be looking, and we'll talk maybe of some of the sectors. If, for example, it goes about connection to the grid, and it goes to actually planning and so on. So the execution is a risk that if you sadly don't have execution, it all dries up. And the last one is that we talked a little bit about the financing as well. Again, if rates go up, if cost of capital increases, and if there is another shock, you may see some of the financing costs going up and potentially slowing down. So those are some of the risks that you could see there. None of them are actually particularly low probability, but at the same time, actually, they're not high probability. So they're all there. Obviously, we can think about something else kind of more dramatic happening, but those are kind of significant enough, actually, to cause us a little bit to pause before we say that Europe is kind of on that kind of a happy path.
Yeah, absolutely. I think I agree with you completely on the implementation point. Again, looking at the data, one of the big concerns is that pipeline visibility, the highest barrier to investment across Europe. I think investors, from the conversations that we've had throughout the interviews, wherever, they are really still willing to deploy capital in Europe, but perhaps can't find enough of those investable projects at the right stage. And I think when you look at the EU as a whole, the fiscal commitments, the policy frameworks, they're all actually a little bit ahead of any procurement realities. And I think that's probably one of the challenges with Europe as well at the moment. And pivoting towards what is driving investor sentiment towards these sectors, we talked about this dichotomy between sentiment being mixed towards regions and countries, but across Europe and the US, fairly similar results on the attractiveness of the subsectors. And Filippo, kind of walk us through what are some of the big movers as well in this year's survey.
Yeah, sure. I'll start, and then I'll get some of my colleagues to jump in as well. I'll start with one which I work quite a lot and is quite close to my heart, but is at the core, in my view, of the energy transition, which is regulated utilities and energy networks. We all know that renewables they are increasing in deployment across the world and in the North America and in Europe as well. But unless you have a grid that can actually move around the capacity that is being kind of built, or solar and wind, for example, not necessarily close to what the demand is, unless you invest in a network, all of that, I wouldn't say is wasted, but to a certain extent is quite an expensive kind of level of investment to achieve decarbonization and energy security. And we see actually a kind of increase in the sentiment and the positivity and actual investment into the grid. And I think he's probably been one of the highest has been in the last few years. So I think that's definitely one sector that you will say is quite hot. And the other point to note is there is a difference actually in networks. There are difference between power and gas. And obviously the power is where bigger demand is. And so you would expect a positive sentiment to power. And it's not just about the grid, it's about last mile companies, or it could be to a certain extent the system capacity, which is batteries, and some other ancillary services being provided by the grid. But also we see quite a lot of interest into gas networks. And there are quite a few transactions at the moment in the market about gas networks. And you might say, but what gas networks are we not moving away? Well, the a little bit more kind of pragmatic attitude to kind of the energy transition and decarbonization means that maybe gas is going to be a fuel of transition for slightly longer than people expected, and therefore we might see another cycle of investment into the gas network or gas kind of peaker plants before you get fully to a net zero world. And I think it definitely is an element that we have seen in the last few months of actually the level of activity going more into the gas and the regulated utilities.
I mean, you look at the figures of US exports at the moment, up 89%, right, over the year. So do you think that's just going to continue driving that more traditional forms of generation over in America? Because as you say, sentiment's really pushed up for regulated gas and electricity in the US and Europe almost from the doldrums, right, a couple of years ago.
From the European point of view, I would probably say that you see more LNG kind of. There was already a wave of LNG facilities being built in Europe, and you will continue to see that because kind of investors and companies, corporates, energy supply will try to diversify as well. And so LNG will come. There was a lot of LNG coming out of the Gulf, of course, but there is a lot of places. And I will see then Australia, the US, even Canada actually starting investing more in export LNG and Europe in more kind of import LNG. So I'll definitely see that kind of trend intensified for sure.
And perhaps from you, Jay, what do you think these shocks, what effect are they going to have on US sectors and outlook?
I think that we're definitely seeing a need for U.S. infrastructure around midstream pipelines related to LNG. No doubt that that's a growing area for the U.S. You see announcements related to new LNG facilities happening a good bit in the Gulf Coast and other places. So I think we'll continue to see that trend, and you're going to need infrastructure to be able to get the gas to those liquefaction facilities. So I do see that as an opportunity going forward. It all, to me, is part of the broader story of data centers and that related infrastructure as well, right? If you are going to build a data center right now in the US, it's become a popular topic about how are you going to power that data center. And that is driven by obviously needing interconnect and or having behind the meter power generation, and then what will happen with excess power there. And that is a hot topic. It's state by state right now, or RTO, ISO, but each one's have their own views right now. And I do think that there's a lot of attention on it, and so it's probably a good thing because maybe some of the earlier projects didn't really factor in how increased drawing off the grid might impact pricing for the common consumer. And honestly, the hyperscalers and those that are building these data centers are actually fine right now. They don't want to increase pricing, at least publicly. That's what all of them have pretty much stated, because they're really just looking to make sure they have security of supply on the power side. And price has become not much of an issue yet. That may change in the future, but for now, it's really more about getting stable power supply than anything around the cost side. So you need power and you need water. And we saw an uptick as far as just interest in those from investor sentiment. I think that probably continues as long as our data center build out continues, which by many forecasts is going to be several years. So we'll see where it goes in the U.S. It wasn't the only area that saw increases, right? You saw regulated electricity and gas. You saw areas such as digital infrastructure that also increased somewhat in sentiment, or at least had a positive sentiment still from a fiber and towers and mast type standpoint. But I do think the broader conversation driving the market in the U.S. and candidly even driving the U.S. stock market, it seems right now, is all around AI, data centers, and the build out around that.
I think it was Morgan Stanley came out recently saying, the returns aren't being made in the hard asset anymore. It's now in the power generation that's providing these data centers. And I think we've seen that uptick linked, perhaps not linked in BESS across the US, battery energy storage. I think it was a good stat in 2025. For the first time, energy storage surpassed car manufacturing as the leading driver of US battery supply chain investment. So that's a big driven by grid issues, driven by the need for less intermittency in renewables. And another one that we saw, which was quite a surprise to me as well, actually, was this huge uptick in renewable sentiment. And in the US, the investors are working against some tight deadlines. So there's the one big beautiful bill. It basically requires wind and solar projects to begin construction before July 4th, 2026 to qualify for full tax credits. And we've seen again this year developers adding, I think, about 40 gigawatts of solar capacity in 2026. That's a 60% increase of last year. The near-term pipeline is absolutely enormous, but by July, that picture darkens somewhat. And if you're not developing solar or solar plus storage, there really isn't an avenue for you to develop renewables, particularly offshore wind. And in conversations with our members, again, investors say that if you're building a business case in renewables off the back of the availability of a subsidy, then it's not a real business case at all, right? So that's, I think, an interesting couple of points to highlight there. And Wayne, in Europe, are we seeing the same kind of power grid, battery storage play out as the US?
I think there are definitely similar themes in Europe, albeit not quite as turbocharged or extreme, or shall I say, not as cooking on gas as in the US. Given that's been a theme of the call, data centers are clearly a very attractive sector, if not the most attractive sector. But actually, from a number of transactions I've been involved in over the course of the last 6 months, investors are still cautious, even when it comes to those assets. And I've actually seen transactions fail in the data center space because of uncertainty over commercial aspects, over capex certainty given increasing build costs, and also over minority governance rights in minority stake transactions. So yes, it's a really attractive sector, but investors have still been relatively cautious when approaching their investment in that space as well. Also BESS has also been an interesting sector. Again, over the last 12 months, I've personally been involved in half a dozen projects in that space. And I think what is interesting, that is across the risk cycle of BESS in the UK as well, from purely operational portfolios to ready to build only portfolios, to mixed portfolios, and to portfolios in construction. And in each of those individual cases, it's been an infrastructure investor that's been investing into that relative stage of the asset. And if you go back 10 years, infra investors were only investing in operational assets. Today, they seem to be taking much more operational or potential operational risk. And actually, the one thing that's interesting, I think, is the UK and Germany seem to be particular areas of focus for BESS investment at the moment. And talking to investors over the last 2 or 3 months, a lot of them are really, really actively looking for a BESS opportunity in Germany. It seems to be where they want to place their money. Other countries, on the other hand, such as the Nordics, are seen as slightly less attractive because of the level of merchant risk or risk within the energy supply system there. So, yeah, a mixed bag. But in summary, same themes, but definitely still some caution there.
On the BESS conversation, Italy as well has had their allocation round, which hit well below the strike price. I think it was 37,000 megawatt hours to, I think it's 12,000. And that's because of those 15-year tolling agreements that they're providing through the auction round. I know we've talked a little bit about data centers already. It's still such a significant driving force of activity, of GDP growth in the US, of activity for a lot of investors, as kind of having a look on all the usual data providers, not sponsored, so I won't name any of them here. And you see now about 1 in 6 infrastructure dollars is going towards data centers. I mean, is there anything that can stop this huge momentum?
I think that right now there's such a focus on speed to market and on having compute power that there really is not a financial discipline around what it costs per megawatt to get your data center up and running. And so at some point in time, that will flip, right? We don't know when that will, but at some point in time, either pricing comes down or, there's a new revolution from a technology standpoint where we don't need as much compute as what we need right now. And so what's interesting to me is just, I think very much so when we're looking at data center deals, especially on the development side, that there's a long-term contracted asset that's involved here. And, you've got very, very creditworthy counterparties in general on the other side of that. And so for an infrastructure investor, I think you're pretty well insulated from that trend, but it will be interesting to see if, you've seen different of the hyperscalers make different decisions on how they're handling leasing opportunities or, building their own facilities. And they've all gone in different directions. It'll just be interesting to see who wound up being the big winners here. And that really just depends upon how much power compute do we need 5, 10, 15, 20 years from now.
I think Jay made a very, very good point around looking at the hyperscalers and some of the kind of the data center and the AI companies. Because if I were to think, probably an indicators to watch will be actually the equity returns and the actually performance on the stock market of those companies. And that will be a little bit of a leading indicator for the infrastructure fund, from the infrastructure sector, that probably some of the investment might taper or slow down. You will see that first. You will see some issues in the kind of the valuation of the Magnificent Seven and some of the big hyperscaler. Then suddenly you say, okay, if they are struggling in that side, it means they will start pulling back on their investment, which will mean that my investment in infrastructure for data centers and might come down. So I think that will be the things to watch. Now, the element around the power to the data center, again, it will be very similar. And the additional element might be to look at for any technology that suggests that actually you don't need as much power to continue for the training of the data center or for those kind of the service and so on. That will be more of a technological issue, more difficult to spot because you might not see that technology under the hood. But that will be what I will be looking at before actually saying that the investment in the AI or AI related from an infrastructure point of view will slow down. I don't see any sign for the moment, but again, we're probably a question that I'm pretty sure we'll be discussing in 6, 12 and 18 months time on this podcast again.
And talking about the Magnificent Seven, is it 4 of them had their earnings calls recently? 3 saw market value drop. Meta was, I think, the only one that rose. So a very interesting dynamic playing out there. And power data centers, all well and good. Our survey and infrastructure in particular covers a much broader range of sectors.
Yeah, I mean, in terms of other sectors, I mean, we've talked about fibre till the cows come home on these previous podcasts. I think there is a move towards consolidation of that sector. A couple of transactions have happened. We've had a couple of high-profile administrations in the UK altnet sector, which have worked through. So things are beginning to move in there. So the sentiment's not improving towards that sector, but transactions are beginning to happen because they have to happen for the sector to move forward. So I think that's worth mentioning. In the transport space, if you look at across that space, I guess activity has on the whole been a little bit more muted than it has been in the energy and energy transition spaces and renewable spaces over the last 12 to 24 months, and that's a little bit driven by sort of GDP risks and those sort of factors. But where we have seen activity and where sentiment does seem to be turning to, which not directly in the survey, is assets that are in the sort of leasing space, and some of those are aligned to the transport sector. So long-term leasing of equipment is becoming an increasingly attractive sector where infra funds see infra-type characteristics in things that you wouldn't necessarily on the face of it see as infrastructure assets. And there's been transactions in that space over the course of the last 6 months, including things like CCTV towers, amongst other things on building sites. So definitely an area to watch is the leasing sector. I think people were beginning to think about more transactions happening in things like airports, with some tick up in that space, but obviously with the fuel crisis potentially impacting jet fuel availability in Europe with an indirect impact on airport activity, landing and takeoff slots and the likes, then that may defer some of the airport activity.
Yeah, I can comment real quick too. In the U.S., Wayne raised a very good point. So we had some issues with the FAA and some outdated technology. I would not be surprised to see some significant investment there and possibly infrastructure investors hopefully getting involved from some form of PPP or other form of privatization just to really drive that change quickly. We also had some funding issues with the security side of things around, again, political instability and two sides not agreeing that, I want to include this along with that and just not being able to get that done. And so there were very long and very publicized lines at some airports where travelers were stranded and were sitting in lines for 4 or 5 hours. Those types of things obviously hurt the airport space in general, right? And so I think that we need to figure out ways to have funding for where there's a lot more stability around security in airports. And so we'll see if that winds up being any kind of semi-private transaction. I don't think the U.S. government would ever release completely the security of America's skies, but potentially there's an opportunity there for an infrastructure investor in the future. The other area is waste. I know we've mentioned it a number of times. I'm sure some people listening to this podcast think that the U.S. is very much so cowboys and not concerned about what happens to our waste, and we definitely generate a lot of waste. But we are, there's been a lot, at least I've worked on a lot of deals around the waste energy space, responsible, landfilling. And so I will say that that's an area where I feel like the U.S. continues to see a lot of volume in transactions. And also we're just seeing positive developments there where I think we're getting more responsible with our waste handling. I'm sure not to the level of our European colleagues yet, but in the future, I think we're going to continue to see the U.S. focus on, especially when it's an economic decision that makes sense, on doing more to actually sort and process waste in a better way.
We've heard us talk about political instability, regulation, funding models. When we think about what investors view as being the barriers to investment, a lot of those factors come up across Europe, across the US, and the UK as well. I suppose if each one of you kind of characterizes the UK, European Union, US, what do you see as the main barriers? What can unlock some of these issues in those markets?
I mean, we kind of covered already quite a bit in this conversation. And I think you mentioned kind of pipeline visibility as one of the barriers. And I mentioned execution. I would probably say definitely kind of speed of execution is what actually investors prize most of anything at the moment. Therefore, a barrier might be it's almost like if the barriers to execution are not removed, which are currently existing in the policy environment when it comes to planning, regulation, and connection, then obviously that will continue to stay a barrier. So it's more about the absence of the removal of barriers might be the biggest challenge actually going forward. Because in a sense, what we say is there is not a lack necessarily of opportunities. So kind of we're talking about kind of there is almost a pipeline abundance of project, but actually a scarcity of executable project. And that's probably a little bit the situation where we find ourselves now. So that is kind of what might actually put extra sands in the gears of actually investors getting project delivered on the ground. And the second one is, as always, a little bit of policy mistakes as well. We always find those, and keeping those to the minimum will be kind of good, actually, for a change.
I think in the UK particularly, obviously, historically, and indeed it comes out in this survey as well, the lack of attractiveness of the regulatory framework in the UK has been seen as a massive barrier. I think everybody recognises that the UK regulatory framework, whilst once upon a time being the what other people looked up to as a way to manage privatised interests, is no longer the case and has been seen as broken. Action is in progress, I guess, to try and rectify that. I think the AMP8 settlement in the water sector recognises the need for massive capital investment. Ofwat is in the process of being replaced and merged with other water bodies, and Ofgem itself is also being reformed. So there's light at the end of the tunnel there, I think, for UK regulation. And I guess from a personal perspective, having been involved in deals in this space over the years, it's been pretty evident that sector of the UK infrastructure space has had a distinct lack of transactions over the last 4 to 5 years. But in the last 6 to 12 months, there have been a couple of notable transactions in that space, including one relatively sizable one in the water sector. So deals are beginning to get done. So does that mean that investors are seeing the light at the end of the tunnel there, and that the early stages of the actions that have been put in progress they do see leading to a better regulatory environment? I guess we'll wait and see.
The reality is that there definitely has been a bit of a sentiment change towards the U.S. But the most important thing to me is we're living in a state of a lot of conflict right now. You've got the Ukraine situation, you've got the Iran situation with the Straits of Hormuz. I think that what you really are seeing, though, from an infrastructure investor standpoint, is you want to have certainty of cash flows, and you need to have a lower cost of capital, which is somewhat strained right now by the inflationary pressures. So I think my view probably is a little bit more macro here as far as what's going to drive, just opening up the floodgates on infrastructure. And I do think lower interest rates is probably the largest driver I can think of right now, and maybe some settling of some of the conflict globally.
I think most markets will look fairly jealously upon the US infrastructure environment, regardless of the negative sentiment that there is around political instability. It is just such a vast, juicy garden to pick from, right?
We're ripe with opportunity, for sure.
Exactly. But all I have to say, actually, to you three is thank you very much. It's been great to have you. Thank you.
You're welcome. Thank you, Vlad.
Thanks, Vlad.
And so that's it for this episode of Talking Global Infrastructure. Really appreciate your time. And if you enjoy this episode, make sure to check out the complete version of our Infrastructure Pulse survey, featuring all the investor sentiment, all the analysis that Alvarez and Marsal team do as well from the past quarter. All will be available on our website at GIIA.net. You can also subscribe to our newsletter. We'll be sharing even more market-led insights each month, and follow us on LinkedIn for industry news and updates on our upcoming events. And if you haven't, make sure that you follow Talking Global Infrastructure on Spotify, Apple Podcasts, or wherever you stream your podcasts. If you have any feedback for the team, ideas for upcoming episodes, or want to get involved, let us know at communications@giia.net. Thank you for joining us, and we'll see you next time.